Hey, what's going on, Cashflow hackers? It's Chris with Life 180. I am here in the studio with Garrett Gunderson. I'm up here in Utah. I don't need to introduce him. All you know who he is. He is the GOAT when it comes to understanding and explaining human life value and whole life insurance and all this stuff. I'm in his studio today. We're doing a series on Index Universal Life, and God knows whatever else is going to come up. It's going to be a lot of fun. So I'm going to cut to the video right now. I'm really excited, just honored to be here. A lot of fun, and let's get into it.
All right, there's a debate out there. Well, actually, a couple debates that are going on. Number one, is life insurance an investment or not an investment? Can you replace your bank with life insurance or not? Is it index universal life that I should do or whole life that I should do? Or is it term and I should invest the difference in the market? Or is it good? Is it evil? There's just all of this confusion out there. So I want to cut to the heart of the matter. And honestly, the person I brought on, Chris, is because we're on the same side of the debate.
Yep.
He was debating someone at a financial event and taking the same side that I would take. And when the person he was debating, they both got a full presentation before they did the debate. And I got angry and yelled out to the other person because I thought there was a fallacy of causation and correlation and this whole thing. And found myself like, why am I yelling? Why is my heart racing? Why am I so fired up about it? It's because in not understanding the truth of this matter, it's going to be so harmful to so many people and to the entire industry, which when you do this right, can be a never fail you strategy. It could be an amazing way to asset allocate to create a lot more control, tax benefit, and improve a situation where most people are stuck in bonds with these interest rates increasing, causing a capital depreciation and losses. So there's a lot to it. And I get that most people, when they listen in, they're confused because the people in the industry are fighting each other. And one, I think, are just simpletons that are going, this looks really good without understanding the reality of what's going on and saying that ours look like bigger numbers on a piece of paper than that paper. But just because I write a bigger number on a piece of paper doesn't mean it's reality or it's going to come true. So Chris and I are going to go back and forth because you created this thing called the IUL challenge.
Yes.
And said, you'd give someone how much money?
$2,000. It started off at 500, and then I went to 1,000. Now I'm at 2,000.
If they can prove this thing out that's being touted as the way all this works,
Sure.
But it's not. So you're like, great,
Totally.
prove me wrong.
Well, the idea of the IUL challenge is simply the way IUL is sold is.
And let's say what IUL is.
Index Universal Life.
Right, which is a type of cash value insurance policy.
It's a type of cash value life insurance.
Built on a term chassis, by the way, which most people don't really understand.
It's basically an annual renewable term that gets more and more expensive. You have no control over it as a policyholder, and it's tied to the index through using what you would earn from a cash perspective in a whole life policy, or even, I guess, any other cash value policy. They take that money and they invest it in an option strategy. And so we'll get into that in another video from the technical perspective.
Which I don't even like options strategies because they're typically win-lose.
Yeah.
You know.
Oh, well, that's 100%.
That's what an option is. Like, I'm betting
100%.
it's going this way, you're betting it's going that way. One of us gets all the money, the other one doesn't.
Right.
Right.
Yeah, 100%. And so but the idea of Index Universal Life, and it got really popular in 2009, right, because of the Great Recession.
Yep.
And it started being sold as this idea of upside potential and downside protection.
Totally.
Right? And so that is the way it's sold. And when you look at an illustration,
it's a good story.
It's a really good story.
Easy to sell.
And a lot of people have bought it. And unfortunately, over the past, so it became popular in 2009. What is it, 2023? So 14 years. There's been 3 regulation updates on illustration regulations because at the end of the day,
they weren't accurate.
It shows really sexy on paper, but it never performs. And so the IUL challenge is basically saying, hey, if this is sold on upside potential and downside protection, every policy over the past decade should have outperformed. Why? Because we had the greatest bull run of all time. And so upside potential, if you're not able to capture that upside potential when the market's doing really well, what are these things going to do when the market's not doing well, right? That's the idea. And so if this story of upside potential and downside protection actually plays out in real life, because I don't care what it says on the illustration, I care what it actually does in real life. Life doesn't exist on a spreadsheet, right? Like so when we look at that, I was like, listen, like I need one person to show me an in-force illustration that is right now, and then show me the original illustration. And I don't even need the illustration currently to beat the original by the percentage that the market has outperformed expectations.
Right.
Right. I just need it to match what you showed, which is quote unquote conservative. Right. Like, I just need to match that. Not one person has been able to do it. Think about that.
Yeah.
Like, I've got one video talking about this on TikTok that has over 600,000 views. I have, a bunch of videos on YouTube, some Instagram content. I've been on other people's channels talking about this. Not one agent has been able to step to the plate and say, yes, here it is. It's the only person, I'm going to say his name here, is Doug Andrew. He tried to go around it, and he created a video showing a policy that he says outperformed. But here's the deal, and I want to make this really, really clear. I created the IUL challenge, not saying it couldn't be won. I fully expect at some point in time I'm going to pay the $2,000, or maybe it'll be $5,000 by the time I pay. So I'll keep raising it until somebody does it. You know what I mean? I fully anticipate I'm going to have to pay. The purpose of me doing the challenge isn't to say, hey, guys, an IUL can't perform, because it can in a vacuum.
It's what's the likelihood?
Right. And so, like, Doug Andrew does this one video. He doesn't want to actually go through the channels of the challenge. He just wants to put this other video out there. And now I got all these IUL agents being like, oh, he's proved you wrong. He hasn't proved anything. He's shown one policy. How many policies has his organization sold? Thousands, right? So you're showing me one. The whole purpose of me doing this is to take the conversation to the next level, to actually educate people about how this works and what the likelihood of this is. It's easy to create marketing around IUL. It's harder to, like, have it be implemented in your life.
Yeah, well, let's just talk about the different types of policies. I mean, there's term insurance, which is just like it sounds.
Yep.
It's in force while you pay for that term.
Yeah, it's temporary.
Temporary. Now, most aren't annually renewable, as you talked about.
Yeah.
You'll see a lot of 10-year level, 20-year level, even 30-year level policies, which is much more common, because annual renewable, the price goes up each year.
Yeah.
And so, unless someone thinks they're going to convert that to a different type of policy, they might do an annual renewable. Otherwise, they might do, like, 10 years seems really common, 20-year.
Well, people are always, if you think about, if you listen to the Dave Ramseys of the world, right? Like, he tells you pay as little for insurance as possible.
Right, because his whole framework and philosophy is expenses are bad and reduce expenses. So I just want to dissect that for a minute, because my second chapter of What Would the Rockefellers Do addresses this philosophy. Yeah. There's 4 types of expenses, and he's treating every expense like the first, which is a destructive expense. You put money there, it doesn't add to your wealth. Yeah. Right. The second type of expense is a lifestyle expense. And where he's really smart is getting people that overspend what they earn.
Sure.
So they're spending more on lifestyle expenses than their income, and getting them to be less of a train wreck and get on track. So I understand that. Don't borrow to consume.
And there's value there.
The third one, where he's really negligent, and I'm going to use the word negligent, is protective expenses. Protective expenses create sustainability. It transfers risk. It's everything from asset protection, estate planning, insurances. Like, here's the thing. We either can transfer risk or retain risk.
Of course.
When we retain risk, people do one of two things. Either one, expose themselves in a way that could be detrimental and wipe them out, which happens far too often.
Yep.
Right? They're one incident away from their wealth being confiscated. The second thing is they can avoid risk, or think they can, but they behave differently. So my great grandma is sitting there watching what she called her stories. They were like whatever daytime television was. Yeah. And she's just sitting there minding her own business, and this drunk driver drives into her house, knocks the grandfather clock over, hits her on the head, cracks her head open. She goes to the hospital.
This is a true story?
True story. So here's the deal. Like, she was doing what she could to avoid risk.
Yeah.
But risk isn't something that we can control. We can mitigate it. Yeah. We can minimize it. But the notion of, hey, just buy term and invest the difference is not addressing the future risk, because what they say, and I wrote about this in Killing Sacred Cows, is you can self-insure, which there's no such thing as self-insurance. You're either insured or not insured.
Right.
But here's my methodology or philosophy is only insure the catastrophic, not the inconsequential. And most people do the opposite. Low deductible car insurance, it's inconsequential in a fender bender. Yet they have minimums for the state, which might be $15,000 max.
Seriously.
So that anything above that is on them. They have to hire attorneys for all that. So it's like, it's crazy. It's poor design and poor philosophy. So I'm all about, where do we transfer catastrophic risk? And one of the most catastrophic risks a family faces is the loss of a breadwinner and that income going away. All you have to do is go to GoFundMe and look how many GoFundMes are out there because someone died and didn't have insurance. And the problem is, the most expensive insurance on the market is anything built on term.
Totally.
Because the likelihood of term paying out is 1.1%.
That's it.
1.1%. Talk to an actuary.
Yeah. That's crazy.
That's an actuary.
Yep.
Okay. So it's such a small sliver. And by the way, the older you get and the more risk you have of dying, the higher the premium.
Of course.
So if you look at a 10-year policy, that 11th year, the cost skyrockets. 20-year policy, 21st year skyrockets. 30-year, insurmountable. If you kept an annual renewable term from the time you were, could buy it till the time you died at life expectancy, because of those last 10 years, you would spend more on the policy than it's worth.
Oh, yeah. I mean, that's a whole rabbit hole. When we start comparing like term, annual renewable term, which, by the way, Index Universal Life is
built
annual
on, but by the way,
term.
I might be wrong, so I want you to help me.
Sure. Let's do it.
I believe it's 20% more expensive than annual renewable term because it can be hidden inside of the policy through cash.
I don't know the answer to that. I think it depends on the company.
That's my, look, that's not detailed analysis.
Okay, sure.
That's me just going and looking at policies 15 years ago, which it was a lot newer back then, and going, wait, like, what would an annual renewable policy cost?
Yeah.
And what is the cost inside of this? And it was just this was like a one-day afternoon looking at two companies. But I do think it's something to be aware of.
Totally.
And say, if you strip this down and only paid the cost of the policy for the term part of it, no cash value being built, and compared that to another term policy, where are you going to get the better deal?
Right.
It's just worth investigating.
Sure. And I think the other important element of the annual renewable term inside of the IUL chassis is that the cost of insurance is, even on a cost per $1,000 of insurance basis, is not guaranteed. Or there is a guaranteed component to it, but typically you're not buying it at the most expensive guaranteed rate.
Right.
And so
you're buying it at the current rate.
Right. So it illustrates at the current rate, but the insurance company has the right to increase your expenses.
Look, and here's the thing. Any insurance company doing any type of policy has the same objective.
Sure.
To be profitable.
So let's talk about that.
They want to be profitable.
Sure.
Right? And so with that in mind, what if something looks better now, but there's more levers that they could pull in the future that
100%.
create profitability for them? I don't want those trap doors.
100%.
When I think of pulled levers, I think of those cartoons where they pull the lever and the people fall down into the trap. And I feel like agents don't understand this because it would change how they present, and it would mean that they'd have to admit that they're wrong about this to other clients. And look, I will at least say this, okay?
Yep.
When I started in financial services in 1998,
Yep.
I sold mutual funds for a couple of years.
High school in '98.
I was in college.
Nice.
I'm 45, so I was 19
Nice.
when I started.
Love it.
I was 19 for 2 months, then turned 20. I sold mutual funds because it was the 90s.
Yeah.
And it was like people saying, well, conservatively, if you earned 18%. I literally heard people say that, right?
Yeah.
And so I didn't know enough. And I was peddling this to people that had double E bonds that are, not earning much interest, but safe.
Yeah.
I just was cashing out their CDs and putting it into mutual funds because I was like, well, look, let's say you earn 12.
But not much
year
interest back then was pretty good for today's standards, by the way.
Right. So I made a mistake. And in the year 2000, by the time March came around, I was really having a hard time sleeping because I was so concerned about this. And I was like, I was all hopped up on my family and friends saying I was a financial genius because I sold them something that I'd never met the fund manager. I could only tell them 10 of the stocks that were held in there because that was on the main report without diving in, and didn't know the trading patterns or behaviors, didn't know the difference between a dark pool and what the public's paying, didn't know about flash trading didn't exist back in those days, but does now. There's like so many notions and understanding the impact of expenses. Like I was just naive and I was selling it and feeling great. And then all of a sudden when the market went down, like they weren't used to losing in CDs, and maybe they were to inflation, but not seeing the account balances go down. And so it was haunting. So between March and May of 2000, I got all but one of my clients completely out of the market. I said, I don't know what I'm doing. I just am regurgitating things and showing you mountain charts. I don't really know what's happening. It was hard to do because I was like young and arrogant as shit.
And those are hard conversations because you sold them on you knowing it, and then you had to like eat crow.
And the thing is, what I will say about that is intellectual honesty is the hardest thing to find from good people that are making a living for their family. I wasn't married. I didn't have bills.
No responsibilities.
So like it was actually infinitely easier for me because I'd only been in the business for 2 years, not even 2, because I started in June of 98. And so to go and have these conversations was excruciating for me because of my ego, but not necessarily like a huge impact on my livelihood because I wouldn't spend any money even when I made it anyway. I was just gathering and saving 50% of every dollar and all that kind of stuff. So now let's take someone who's been selling this for 10 years. And there's something called Parkinson's law. And in finance, it's an expense when income increases, expenses rise to meet or exceed, right?
Correct.
And I would say it as a luxury once enjoyed becomes a necessity. So now maybe your kids are in private school and maybe you're used to eating organic foods and maybe you just got a brand new mortgage on a beautiful home. And now you got to go tell your clients, maybe this plan won't work. I think part of the problem is good people can't see the truth because it's too expensive for them.
100%.
I mean, I'm cutting right to the heart of the matter here, but the arguments don't hold up when you look at different scenarios. So here's the other story I told you on the drive up.
Yeah.
What happened to me is I'm selling mutual funds and the market's changing and they bring in this guy, I said, from New York that had a ponytail and a bald head, which was just very unique. But he was really New York where he was just like, he was just straight up like, you're an idiot.
Okay.
If you're selling variable life, variable universal life, and, all this kind of stuff. And I was selling mutual funds and I was like, damn, and he's like, here's the 10 years that the market was on the biggest bull run we've ever seen. And here's how far ahead of it is of just a standard whole life policy that's overfunded. And I was like,
and it's marginal.
Razor, it was ahead. But he's like, so now that the market's going down, we're a few months into it. He's like, usually like people will tell you, well, it's, it doesn't go down 2 years in a row. Guess what? It went down and it didn't go down 2 years in a row. 3 straight years in a row. And I was like, thank God I saved hundreds of thousands of dollars for my clients. It would have been millions, but I was so young. I didn't have that much money under management. So I was glad that I learned the lesson. It's this notion of, there's a book called Love and Logic on raising kids.
Okay.
And it says the most important thing is to teach your kids lessons when the stakes are small. It's hard to learn those lessons when the stakes are high. And so, you're a professional poker player. I always would tell this story. I'm like, if my kids came to me at 18 and said, I want to go be a professional poker player, the first day that they go to do it, my hope is they lose it all. Because if they make the money and it had to do more with luck and not their skill, this is what happened to me in real estate. My first few real estate deals were so lucrative. My first one ever, I put 25 grand in. 3 months later, I got 50 grand back. That's a 400% annualized return. Not bad. My second deal, no money down, bought a property for $190,000, sold it for $180,000 more a few years later. I got 50% of the profit because the tenant shared in responsibility because they were going to default on the property. So I'm thinking I'm a genius. It was just timing and luck, not genius. And so I just think that this is important background as we're looking at these kind of things, because just because someone does well for you in your portfolio for 3 years, it might have nothing to do with their skill set. Most of them are simply handing their money to someone else. They're just a middleman getting paid on assets under management, and they get paid even
Totally.
in years that you lose. It's a really good deal for them, not as good of a deal for you.
It's circumstantial. It's environmental.
Right.
Like it has nothing to do with the individual, their skills, their connections, their ability to actually help you accomplish your goals. And ultimately, one of the things that I say all the time is, one of the things that I see is that people say they want one thing, and this is just human nature, and then they do another, right? Like, and I think one of the reasons that people struggle with money is because they're living out of correlation with what their values and beliefs are, and their money is not in alignment with their own values and beliefs.
Because the narrative, let's face it, the narrative is money's complicated.
Mm-hmm.
You're not going to understand it.
Yeah.
Trust the experts.
Right.
Set it and forget it.
Yep.
Invest early, often, and always.
Yep.
You're in it for the long haul. High risk equals high return. All these things that we're taught not to question because we're just giving it to the Ivy League brilliant people.
Yes.
And even the person that's your middleman that might not be Ivy League is handing it to them. But my argument is, just because they're better at scoring well on a test, and it was harder school than you went to, they might just be better at extracting value, not at creating it. Because Wall Street's mainly a value extraction mechanism, not a value
100%.
creation mechanism, meaning companies go public. Wall Street is always paid on that. You know, your portfolio goes down, they still get their percentage. Like, there's so much to
100%.
all that most people are just, and the thing is, but people don't like to lose. So this IUL story is brilliant. Hey, you've got downside protection with upside potential.
100%.
Well, how much upside potential is there, by the way?
So, on paper or in reality?
In reality, right?
Well,
That's
so
the thing.
so here's the story. Because they like to sell stories on, upside potential, downside protection, and that's the story that's used to sell IUL. So I like to use another story for IUL, and that story is like, because we're both business guys and real estate guys, and so. And that's who we work with predominantly, right? Like, as we like to serve those audiences, because that's, I think, where we add the most value, right?
Yeah.
So when we look at that, I like to use this analogy and say, all right, imagine, Garrett, you have the opportunity to choose one of two business partners, right? You're going to go into a business partner relationship, and you go to one business partner potential, and that person says to you, hey, Garrett, listen, look at my projections. I've built up this model, this business plan. I have this all figured out. And by the way, that this business partner kind of has a history of touch and go-ness. It hasn't really performed. Maybe he's had a couple wins, but most of the time it's kind of touch and go and hairy and like whatever. But he shows you, this business plan, and it looks really good. And on paper, the numbers are better. There's more upside than the other business partner. But he says, listen, I know I've had kind of this past. I know it's been, whatever, but let's not think about that. And by the way, the only thing with this term of this business contract that I want you to sign for me, and I want you to put all your money into this. Like, you are financing this. You are funding this business. I'll operate it. As soon as you sign on the dotted line, you give up all control, and I have all control of everything to do with this business. You have no say. Even though I have this background, are you going to do that? Versus the other side, the other partner says, listen, Garrett, like, I know there's this other opportunity for you. Our upside may not be as high. It may not be as sexy, but I promise you, if you look at my track record, I always win. You may not make as much money on paper. We may just as well kick their butt. But my first and foremost objection is to make you whole and to make this business succeed and to make money every single year. As an entrepreneur, which of those two are you going to choose?
Well, before I say the choice, let's go through the psychology here of why people make the choices that they do.
Okay.
The first psychology is, if we interviewed 100 people and asked this simple question, do you feel further along than you expected or further behind? What percentage of people say further behind?
At this moment in time,
This
like for
moment
where
in time,
they are, if we
right
did a poll,
now. Yep.
90% feel further behind.
Further behind, 90%.
Sure, 100%. Yeah.
So 90% of
Maybe
people
more.
have been shown and told high risk equals high return. It's just part of, like, high risk equals high return.
100%.
Like, look at every mountain chart. Aggressive growth fund, higher return.
Yep.
CDs, lowest return. Like, so when I went to school and learned,
program.
I got a finance,
Yeah.
degree. Some of my finance classes showed that.
Mm-hmm.
But it never showed that? Corporate finance. corporate finance was when people go, how did you write Killing Sacred Cows at 27?
Right.
I was like, actually, I learned a lot of it in two ways. One, early mistakes. And most people don't make the same mistake twice. They make it 15, 16, 17 times.
Right.
So I just started to learn earlier than others by not having the attachment to the income, but just being concerned about the intellectual honesty. And I had partners that were the same way. So that made a big difference. Yeah. Like I'm here to tell you, like, if I could have never discovered the problem with 401ks and write about it in Killing Sacred Cows, I would be so much wealthier financially, because if I was willing to sell 401ks,
oh my gosh,
the average like lifespan of someone that's in a 401k with even a poor advisor is 8.5 years. So as someone's had coaching programs, to have someone stay in a coaching program for 8.5 years, it's really difficult.
You got to be adding a lot of
really
value
difficult, and it's a lot of effort. It's a lot of work. It's a lot of investment. 401k, it's just built system that people just have accepted. But once I knew that there was limitations, the fees, the lack of cash flow, the risk of the underlying funds, the expense ratios that start to deteriorate the return, the administration costs, that 15 main issues that I discovered in that, it was a bad day for me. Mm-hmm. I was like, damn it. Hey, this isn't tax savings, it's tax deferral.
Yeah.
That blew my mind. It took me a long time to wrap my head, meaning it took me hours, not years, but I kept going because I thought, okay, I put $10,000 in, I pay $3,500 less in tax. That's a $3,500 savings. But then I was like, okay, where does the $3,500 go? Wait, it's not my pocket. It doesn't show up as spendable cash.
Right.
It's that I didn't take constructive receipt of the income. So it lowered my income that year, but it's now stuck in a plan, deferred, that when I go to take the money out the next day, I'm at a 10% disadvantage because I pay the tax and the penalty.
Yeah.
And I'm potentially at a disadvantage if taxes go up in the future. And tax brackets have been over 50%, the majority of the history of the tax bracket. Right. So it's actually historically low. So I was like, this is all terrible news. I didn't want to learn it. And again, I just didn't have as much at stake. I didn't have a huge client base. And corporate finance showed me they don't believe high risk equals high return. That's not their notion. Right? Because high risk equals going out of business too quickly and a fiduciary responsibility to shareholders that they could actually be sued for being reckless. But in our personal finances, we're taught it's a black box. It's too confusing. So high risk equals high return. So people go, well, there's more upside potential. And what happened was with the so-called downside protection, not looking at the potential cost increase of the insurance, not understanding what happens when you take a distribution, because most of these agents selling it have never got clients at a phase where they're taking distributions or they're older. They're just living in ignorance. But now they're so sold on that ignorance, because if they have to go back and say, I may have given you the wrong thing or didn't have the best advice, they're worried about their online reputation. They're worried about feeding their family. Yeah. They're worried about lawsuits that could come in. There's just all this thing that keeps them doing things that they can't even hear the truth anymore.
Yeah, I think one of the I guess phrases I've always thought about, and I don't remember what book I read it in, but it's the quality of your life is going to be directly correlated to the quality of questions that you ask yourself.
Yeah.
Right?
That's what I'm a firm believer in that.
And so that's it. And I think what I've seen right now in the rise of IUL in the past decade, because when I got into IUL, it was 2000, like when I was really, really in it, was like 2009 through 2014, right? And during that time, I mean, first of all, the market's changed a lot since that point in time, as far as the index universal life space. Back when I left the market, there were 14 companies selling IUL. There's over 70 today. And we'll get into that in another video about like what that means for the market and how actually that creates a lot of problems for IUL companies and for the actual policyholders. But at the end of the day, most of the agents right now, they're coming on with these large IMOs that are kind of like network marketing style, where they're sold into this dream of building their own business and, being in business for themselves, but not by themselves. And like, there's a lot of that story that is attractive and that, makes sense. The problem is, once again, just the chassis that they're leaning on. And the real problem is you get it's like, I call it the blind leading the blind, right? Like the moral hazards built into the industry right now when it comes into recruiting these agents.
Let's talk about that moral hazard, what that means, because I talk about that a lot, and I want people to understand that term.
Yeah.
Because it's kind of like a conflict of interest that this moral hazard is like they're putting people in a situation that's not good for them, but it benefits the agent.
Yeah, and
I want to say, I don't really think these agents are bad people.
99% of them
great people trying to do the right thing. It's just like once, dude, this guy, it's a insurance guy, like the insurance leader for an IMO, sent me an article like I didn't know anything about insurance. Like, hey, I want to teach you what IUL is. He's like, because it's whole life's too complicated for our agents to understand. I was like, what? Because they sell indexed annuities. And so they thought this is a perfect narrative or match. And I was like, I used the F word with him on the phone. Like, it's like, dude, what? And I was just like, what are you, like, you're treating me like a child here. And it's like, I could see his ignorance, because it's just the easiest narrative, not what's best for the person. Right. Just the easiest narrative. And so this moral hazard, let's go into what you mean by that in this insurance industry and what's being caused.
Well, I think what it is like, I just think about my background, my history, and my story, right? So, and my why behind what I do. And people ask me all the time, Chris, why can't you just shut up about Index Universal Life and focus on whole life? If that's what you believe, focus on what you believe. I feel a calling. Like, all the IUL content that I make isn't to just be like IUL's horrible and bash on it. It's to educate people and to expose people
the story they didn't hear.
Yeah, and to expose people to the information that I had to learn the hard way to make my decision to shift from IUL to whole life. Because I think when I got into
Did you have an IUL back in the day?
Oh my God, I had one for me, one for my daughter, one for like.
Well, dude, I was in a worse situation at 18 years old.
Yeah,
I bought a VUL.
Okay. Yeah.
At 18, they showed me $70 a month. I wasn't even making hardly any money. I was in college. Like, I don't need the tax benefit, but later you will. And they showed me an 18% return.
Yeah, that's
year
insane.
after year at World Financial Group.
Oh,
18% year after year at World Financial Group. And then I was in econometrics class, as I told you on the way up, where I ran Monte Carlo simulations, and I did a thesis around the likelihood of this working in 97 point whatever percent failure rate. Not that it was going to be worth multi-millions as they told me.
Right. It was going to lapse.
It was going to lapse because of the cost of insurance, and I was minimum funding it. So, because that's the argument people, well, if you would have max funded.
Yeah.
But VUL is even worse because it's now sub-accounts that are like mutual funds that if the market goes down, your cost of insurance goes up at the time that you're losing money in the market because they charge you based upon the net amount at risk. What's the difference between your cash value and death benefit? Determines your cost of insurance. The older you get, the higher the cost of insurance.
Totally.
A. B, the less money you have in the account, the more you're being charged for.
Yep.
So you have the market going down as you get older. So it's dipping that almost triple ways because it's less shares.
Yep.
They're losing value. You have to sell the shares to cover the cost of insurance. It is a and I know people that are moving again to talking about VUL. I thought it was dead. I didn't even know it was around.
It's a renewing market, and I think I don't know why. But what I do know right now is that for every one whole life agent, there's 20 IUL agents, and I just try
because it does look better in best case scenario on paper. Like you said, this other side, they're like, well, I don't know. It doesn't always work, but
I don't even like to use those terms. I don't even like best case scenario. Like, to me, like, it's a dream scenario. It's not even best case scenario. People, when they run the illustration,
what's the likelihood it happens?
So when I
IUL challenge says.
So when I talk to Bobby Samuelson and
who's that?
So Bobby is to me, the most authoritative mind on life insurance product design and understanding how they actually work internally, right? He gets paid by every major company to come in and speak about product. Like, he's a nerd.
Love it.
Like, used to do product design for companies like MetLife, like stuff like that, right? Like, he's that guy. He started in the business in his 20s on that side, on the corporate side, and now he's just.
Oh wait, a fly just landed on me, just trying to torment me.
But then it went away.
It went away. It's like, yeah.
So when I talk to him, and when you look at illustrative assumptions right now that they say they're conservative, even on good years, assuming none of the levers get shifted, those illustrative assumptions assume it's basically an assumption. It's 50% likely it's going to perform worse, and 50% annually it'll perform better. So, okay. So we have to look, what's the upside? What's the downside? Can I live with the downside, right? And so when we compare these things, the problem with an IUL illustration is that it's assuming good years every year. The problem, though, you just talked about the net amount at risk. On down years in an IUL, it compounds the problem, because what it does is it creates more net amount at risk. It increases your charges. It makes it so the policy doesn't have the cash crediting, so the money's not compounding. At the same time that your money's not compounding at the same rate and you're not getting credits, your cost of insurance is going up, and there's a bigger net amount at risk, so the amount that you're insuring is going up. And so those, and it doesn't seem like a big deal, but like, and we're going to have to do another video on,
we got a lot of videos coming out.
We're going to have to do another video on this, but you talked about VUL in retirement and how there's the risk and how it was worse because of the net amount at risk going up with the risk in the market. This whole idea, there's a guy named Patrick Kelly who wrote a book called Tax-Free Retirement, and that is like kind of like when I got into the business in 2009, it was the book, on IUL, and it's what like pushed the whole industry forward. He was like the godfather of the space. People are still using this exact book, like
even though the space
has completely changed, talking about the concepts. But the bottom line is this whole idea, IUL is sold as a tax-free retirement vehicle, as an alternative to a 401k. And you're doing so the same way that you would do with whole life. You just do it differently, and the expectations are different about it, obviously, which is everything. Everybody likes to downplay that, but like expectations and understanding of what you're actually doing is everything. But I talked to a guy yesterday, for instance, $40,000 a year of income assumed after paying $12,000 of premium in for 20 years, right? And he's assuming $40,000 a year of tax-free income out of this thing. But the problem is when you take income out of an IUL, it's in the form of what? A loan.
Yeah. And so I want to hammer this home, because this is questions I have for you.
Holy crap.
Because I have assumptions of how this works, but because I haven't really sat down and sold an insurance policy I think I was an insurance agent from 1998 to 2005, 2006.
Yep.
And then dropped my FR contract, which was a contract with Guardian, because they didn't want me to do a radio show.
Okay.
And they didn't want me to go speak at other Guardian agent stuff, so I just dropped my contract.
Whoops, for Guardian.
This definitely would have been a lot of...
Yeah.
And I had to give up renewals,
okay,
which sucked.
Oh, that does
But
suck.
again, like, this is who I am. I'm like, hey, I want to do the life the way I want to do it.
Totally.
And if it, so I look at IUL, VUL, and UL in general as boarding an airplane and the pilots don't know how to land. You're like, but wait, this is a faster airplane.
Yeah.
But wait, look how good looking this plane is versus the other plane that just looks pretty plain.
I have a guy, I'm not going to call it, he's an influencer on YouTube, and he's an IUL guy. And he made a comment to me because I kind of called him out on some stuff because that's just what I do. And he responds to me because I basically told him on an illustration, I broke it down, how an illustration that he designed that one of his clients shared with me that I did an evaluation on publicly, so I kind of picked the fight, so I'll take that on.
Yeah.
And he came back and he's like, oh, well, you're missing the point. Like, he doesn't need to take all that income on that year if the market's down or this or that, like all where
but
all
you
the risk.
showed it coming out.
But I'm like, but you showed it coming out and you set the expectation. And furthermore, most of these people that are selling IULs as tax-free retirement, they're also getting rid of their 401k. They're having them put all
they don't have a way to income smooth or pick one thing versus another.
Like, it's one thing when we're talking about utilizing whole life insurance as tax-free income, as a bucket of money that you can lean on in times of hardship, as a volatility buffer.
Great volatility buffer.
As something of that
Which we'll
nature.
get into what that means.
Sure. So it's one thing when you're leaning on it as part of a bigger strategy.
But when the solo strategy?
And I won't say it's the only part, because there are some people that do it as part of a bigger thing.
Right.
But it becomes a big part, like a foundational part of a strategy. And if you're leaning on an IUL like that, you're basically, it's financial suicide.
Well, that's a pretty bold statement. So let's take us to a retirement and distribution, because here's where my questions are. Okay. Question number one. Agents go, but you have these riders that can protect you.
Okay.
do those riders stay or go away when you miss a payment? Because they love to talk about the flexibility.
Well, so you don't miss a payment in IUL. So IUL has a totally flexible payment.
But if you stop, if you don't make a payment, it comes from your policy.
It comes from the policy.
What happens to your net amount at risk?
Depending on what type of death benefit you have. If you have a level death benefit, the death benefit will go down, and it'll
called option 1 typically, right?
Option A is level. Option 2, option B is increasing. And so the idea of when people fund policies and the way, like a properly designed, which is the biggest freaking oxymoron I've ever heard in my life, a properly designed IUL is do option B while you're funding it, flip to option A
when you're taking while
you stop funding it, and when you take distribution. On paper, because regulation AG 49A and B allow for positive arbitrage of 50 basis points.
We'll get into what that means.
Loans,
yep.
It shows sexy. It shows like it works, but it doesn't work.
Can you take a reduced paid up policy in the IUL?
No, you can never pay up a policy.
So that's a pretty important note, because we'll get into what whole life is. And whole life has its downsides, especially if people get into it for the wrong reasons and how they're using it. I've seen people that are going, pay your groceries out of your whole life policy.
Side note, any financial product has downsides if you don't understand what you're doing.
If they can't tell you the downsides, run.
100%. If you never put your money into anything you don't understand. How about that? Let's just start there. There's an element of self-accountability and self-responsibility. I think the thing, side note, I'm going to go on a little tangent here, but the thing I love about what we do is I always say to people, you are where you are in life because of who you are, right? You, me, and you want to build more. I want to build more. We're ahead of where a lot of people are. A lot of people are ahead of where we are. But we have a life that we want to build. And you are intentional about what you want. I'm intentional about what I want. We look at where we're going, and we reverse engineer everything else to get there, right? I mean, it's pretty simple. The thing I love about whole life is that it's all about financial structure, right? And it's not about whole life. It's about thinking about what does it take to be successful and for me to create the life that I want to live, right? And we build it foundationally, and we start thinking about the attributes of money, the attributes of the assets, how do we build our life? And you just kind of happen to fall into whole life because it fills the need, And
because it's more risk mitigated, and it's a good storage place for
totally. And one of the things you touched on it is the whole concept of risk, right? To me, the greatest lie in personal finance is the younger you are, the more risk you can take. I proved it in Killing Sacred Cows.
100%. I did this chart where it was, I know you know this chart. It was what if you had $100,000 now, and you're not going to retire for 30 years, and you get to choose the year that you lose money. You have to lose it for 1 year. What's the year to choose? Everybody says the first year, but then I would just show if you lose in the first year, the opportunity cost is identical in loss that if you lose the last year. So even if it's the last year, you lose 10% of a bigger pile of money.
Yep.
But if you lose in the first year, you lose 10% for 29 more years compounded.
Yep.
And so, Warren Buffett had a really good quote on this where he talked about this investment. I think it was in a gas station or something.
Yep.
And it was, at the time, he was young. It was 20% of his net worth. And he says, based upon the returns I got over my lifetime, that loss was 20% of my future net worth.
Totally.
Because of the 22% he was getting every single year compounded.
Yep.
Interesting
100%.
About him is if you take out his top 5 investments,
he's done.
It's not that great of a return.
Yeah.
And so people
glorify him.
Yeah, they glorify
Yeah.
it. And so it's interesting.
Well,
and by the way, he also from 2000 to 2002 bought $7 billion of death benefit on existing policies.
I didn't know that.
Yeah, it was basically he didn't know where to invest because he was always anti the internet at that time. Thought it was too early in the model.
Yes, exactly.
And so he bought senior settlements and viaticals.
Oh, okay.
For a place for his money because he knew that Berkshire Hathaway would be around longer than the people that own the policies. And most people don't realize is there's actually, and I haven't proven this out for 10 years, but when I was meeting with actuaries and trying to understand everything at the deepest level, there's a 13% arbitrage in insurance policies because of lapse. And the insurance industry got really upset or concerned, and you saw they changed the application process to ask about stranger-owned life insurance and investor-owned life insurance. because they were trying to discourage it. And they were basically not wanting investors to come in and buy policies on people, because what would happen is you have to have an insurable interest as part of the process to get insurance. So investors were like, we want to buy insurance on people. So if they could buy insurance because they have an insurable interest for their family, then sell the policies to us, it created a pressure on the insurance companies, because that arbitrage of policy lapses. And part of the reason why there's policy lapses is because of the inward fighting in the insurance industry, VUL, IUL, whole life, term,
contribute to that
and the
bit,
churning contributes to it. But now all of a sudden, the people that were most likely to die, meaning let's talk men over 62 and women over 70, because that's really where the Warren Buffett thought process was. They were even buying term policies if they were convertible.
Sure.
They were saying, what people, if they went to get insurance today, would have a lower rating than their insurance policy? That was the target. Because now the death benefit's worth more because of the information. And the insurance company has a really good 7-year period where they have pretty good control because of the law of large numbers and underwriting, but they start to lose control over their numbers after that because of the changes in health and because
human
of
behavior.
Like it could be COVID, it could be, there's a number of factors that could come in. And so the longer out that policy is, which is why they love annual renewable, 10-year term, they're going to charge more for 20-year because they're in that phase where they have less control. Right. So the thing is, they want a well-rounded portfolio. You probably know more about this than I do. Like, they want to sell some whole life, but they don't want to sell only whole life. That would be problematic for them to be on the hook for only whole life or only IUL or only term. Like, there are some only term shops.
Oh, there's a lot of only term
but
shops
they like the
because
higher
it's all
deposits of cash value. But but if we go back to the actuary that told me 1.1% of term policies pay out, that's a really high 98.9% of money coming in doesn't have to go out. And this is part of the issue I have with like a company like Aflac with some of their policies is their rate of return, meaning for the policyholder, is for every premium dollar that comes in, they're paying out 35 cents. That is a crazy margin on some, not on all their policies, but on some of their supplemental policies. Like when I saw my grandparents were, I think, my first clients, and when I was combing through all their stuff, we ended up doing a whole life policy on my grandma, which was $350,000 death benefit that paid out more than $350,000 because she lived till 85. But what we did was we got rid of all these supplemental policies. Like she had an accidental death and dismemberment. She didn't die of an accident. So that wouldn't have paid out. So that was just wasted money that we now had with a guaranteed paying out policy. They had all these little supplemental policies for hospitalization and all this kind of stuff, which at their age, they had coverage through Medicare and Medicaid. So we got rid of that, right? And what happened was when I started working with me was in 98, and we got them actually with them, we started just doing an immediate annuity that paid the insurance premium. So the market tanked, and they would have lost 50% of the retirement value. But instead, at age 70 to 73, they would have lost over 50%.
Of course,
And now instead, they were giving $50,000 more to each of their 5 children at death, tax-free, above what I ran the calculation if they would have stayed in the market, never touched it. So it's like less risk, more benefit. So like that's part of the process is what we're looking at here.
Well, I think you know, just to kind of wrap up.
We'll wrap this up, but then we're going to come back into this is the next video. Just on distribution of IUL.
If
you're ever going to take, I've got so many questions for you on that.
That'll be an amazing.
I obviously have a lot of knowledge around this, but some of mine now is conjecture. So I don't talk about it. So this will be the first time I've ever talked about some of these things because I know that you were in policy design.
This is going to be fun.
And it'll be fun. And so let's land the plane. Go ahead.
So here, what I would say, it just kind of finish up some of that thought too, is structure. And I know I'm preaching to the choir here with you, is structure is more important than return, right? Like, and not just because of finance, but because of who we are as people, right? So it's a growth process. This whole money thing, your mistakes, my mistakes, what we do.
Which I've made them.
By setting up the structure and asking the right questions early, instead of trying to take a lot of risk and risking it all in Bitcoin and crypto and all that stuff. It puts you through a process. I promise, if you focus on saving before investing, you focus on structure, you're going to become a better investor that's going to help you avoid those mistakes or mitigate those mistakes.
We're going to mitigate that. Yep.
Right? And the other thing that
by the way, a lot of insurance agents got swayed by the seductress called crypto.
Yeah. Oh my gosh.
Or swayed by these things because, and what's weird, because the philosophy of safety and stability was the opposite, but they couldn't help but to pay attention to the strippers over there called
like the
crypto.
Siren calling,
right?
On
and
the
it's
side.
like, but you know, like, look, man, I made my mistakes in getting over leveraged with real estate before 2008.
Totally.
I mean, you know, it's I get it. Like it all happens.
It happens.
But here's what I'll end my side on today, and then you can end your side, is in the absence of philosophy, principles, and strategy, someone else will sell us theirs, and it may not be in our best interest.
100% the case.
So we got to give them the questions,
Yep.
the mistakes and misinformation, and the considerations, so that people can be empowered to make a choice for themselves.
Yeah. So, oh my God, I could go.
We got more videos.
I could go so far down that.
We got more videos.
But yeah, so the one thing I would end with is, if you're considering life insurance as an asset in your life, in your portfolio, to fit into your world and your finances, I would ask yourself, do you want to be, and I would say, ask yourself this question: do you want to be a partner with a company and participate in the profitability of that company, or do you want to be a profit center for that company? That is the fundamental difference between the two.
The cartoon lever that gets pulled, and then you fall down in the trap.
That's
and you're
it.
like, sorry,
right?
You signed the contract.
So I'm just saying, like, that's what I would, ask people to really contemplate and think deeply about, and we'll talk more about those in the future videos.
All right, so here's the deal. We're helping you discern truth from falsehood when it comes to one of the major decisions of how you allocate your money, and understanding term versus index universal life versus whole life. There's going to be a whole series I'm going to do with Chris here to help us dive deeper and get to the truth of the matter. Now, if you like this video and enjoyed it, there's so many videos around life insurance and cash value and this, and it's some of my more popular videos on the channel, so I encourage you to check it out.
All right, so we just got done breaking down I think, a lot of different elements of index universal life, and this is a really confusing topic, and I think I'm super excited to be in the studio with Garrett today, because I get really nerdy and really technical about this stuff, and I think that's probably one of my greatest values and strengths and offerings that I can bring to the industry. Sitting and talking with Garrett on this stuff and bringing in all of the other elements of life and finance and mindset and just human nature coming into this combination is going to be amazing. So we're putting this series together that I think is going to be probably changing the industry, honestly. It's going to hopefully open a lot of eyes up, because why I do what I do is to help other people come to the realizations that I came to after selling millions of dollars of index universal life. So hopefully you found value in this. If you did, share it with as many agents as possible. And if you're looking to get a policy for yourself, if you have any review, you need help, just reach out. Link in the description below. Have a blessed, inspirational day. We'll talk soon.